What do you think the action in the Treasury market is telling us, if anything, about the level of risk aversion we now have in markets around Russia, Ukraine?
Sure. Well, good morning, and thanks for having me on. The situation in Russia and Ukraine is certainly a geopolitical risk that the markets have been bracing for. You've seen that in some of the flight to quality assets over the past couple of weeks. Gold has done quite well. The Swiss franc has done well. The yen has done well. And even the front end of the Treasury market has done well. So it's our view that the Fed is well on their way towards tightening monetary policy. They've telegraphed that very well. We're going to get the first hike in the middle of March, and the market's gone on to price about 200 basis points of Fed hikes over the next year and a half or so. So this is going on with a pretty volatile geopolitical background. But the most important thing is that the Fed is behind the curve in terms of fighting inflation, and that's their number one battle right now.
Stewart, some of the data, though, is a little worrisome. I mean, the consumer confidence February print suggests that maybe Americans are becoming a little weary of the higher prices they're having to pay at the moment, particularly to fill up their cars. Do you think that the Fed actually might take a meeting out just to contemplate what the twin impact of the current economic data and these geopolitical risks might actually be on economic activity?
Yeah, it's a great point. And what we're seeing is a meaningful slowdown in growth. We had 5.5% growth roughly in 2021. First quarter in the U.S. is on target for about 1.5%. And as the year as a whole, something closer to 2.3. So what we're seeing is an impact from higher oil prices, the negative fiscal impulse that we have in the markets, the fears of Fed tightening and higher oil prices. All of this is leading towards a reduction in consumer confidence and a reduction in consumption. So the Fed's going to be really threading a needle here as they try to raise rates to fight the number one fear, which is that 7.5% inflation. But they'll be doing that into a slowing economy. And I think you're noticing the volatility in the markets, as you mentioned, quite volatile. The credit markets are volatile, emerging markets are volatile, equity markets, and that's because of the tightening that's going on globally while the economies are starting to slow.